Hi, everyone. My name's Jared Levy. I'm here with Susan Byrne. She's founder and vice chairman of the board, as well as Adrian Helfert. He's director of multi-asset portfolios, and we are recapping Westwood's annual Outlook Breakfast. Pretty excited to have you guys. It was a super informative day. I wanted to start with you, Susan. You said a lot of words about change.
Yes.
And how the markets are mechanizing, they're evolving. Can you recap a little bit about, you've been 37 years, you founded the firm, right?
Yes,
things have changed quite a bit since 1983.
Yes, since the covered wagon days.
Yeah, not that far back. Talk to us about the changes you're seeing and what you
The changes we're seeing now in the days in which I started in the 70s and 80s, we did not use computers. When I started as a young analyst, I used a slide rule. Wow. For those who know me, they find that pretty amazing. But at any rate, now computers and communication services have given everybody information. And oftentimes, as we've known from studying, if you don't know where to put that information, it tends to overwhelm you. If you're supposed to make a decision and there's too much coming at you, you tend to not make a decision. So we are using now, from the days of the slide rule to the days now where with a computer in your hand, the main thing that is really important in managing the risk and the outlook for clients' assets is judgment, human experience and judgment. And then you kind of put it together with the courage to act on it, and maybe you have a good professional money manager, and that's what we talked about today.
Yeah, and it's difficult. You work a lot with data, with numbers, sifting, sorting, trying to find things that are applicable and useful, and trying to sift out the useless information, right? And there's a lot of that, unfortunately. The world makes a lot of noise. You talked today about a lot of great topics. I think one of the things on most folks' mind is the cycle. It's a long cycle. We're late in the cycle. Can you detail a little bit about where you believe we're at and maybe where we're going? I thought that was something fascinating.
Sure. Thanks for the question. We are the longest cycle in history, and that's been the case since mid last year. The S&P 500 is up 350% since March of 2009 and continues to appreciate as we see now. Now, that said, we're not the greatest cycle in history. What that means is that nominal GDP growth, or our real economy, has not grown as fast as it has in previous cycles. So that said, we're still sitting below as far as an economic growth level where we were in previous cycles, yet the S&P 500 has gone very far. So thinking about where we are today, well, the consumer is in pretty good shape. Their balance sheets have actually right-sized a little bit. We don't have as levered of a balance sheet as in the past. Yet corporates have been borrowing very significantly. They can do that when the central bank is providing them with very low interest rate policy, and the amount that they pay for their debt is allowing them to continue to make their obligations. So we can continue this. The central banks is certainly helping us with monetary policy, with low interest rate policy, with balance sheet policy, and continuing to provide stimulus to the economy. At the same time, the consumer is more resilient than in the past. So
I want to play devil's advocate for a second. There's a lot of folks who, we'll call them, the sky is falling, if you will, throwing the recession word out there. You believe it can continue. What do you say to those folks? What do you say to the experts? And I see them all the time on Fox News. The recession's coming. I'm in your camp, but how do we rationalize that? How do we rationalize the continuation, if you will?
Sure, and that's something we look at every single day. I'm certainly a student of history, looking back at previous cycles and saying, what are the causes of the cycle downturns? We're never going to know what the cause of the next downturn really is going to be. We always know what's going to be coincident, which is going to be a contraction in financial conditions. It's going to be markets stop lending to other players so you can no longer borrow. All of a sudden you end up with a default cycle of corporations and individuals that heightens and causes a retraction from markets. Every time that happens, what causes that? Well, we don't have inordinate leverage like we had in the past, or as much as we had in the past. As I just talked about, we have a monetary policy or a central bank that is saying, whereas used to, they were a dual mandate central bank, labor and inflation. The FOMC governors would sit and speak and say that's what we're going to evaluate the economy on. I tend to think it's a triple mandate central bank. They're looking at the S&P 500 actively and saying, the wealth effect, the transmission of your real estate prices in your 401k portfolio is very important. Thus, when things go down, they're going to support you, just like in the old Greenspan Fed. So it can be elongated, in part because of the lack of excesses that we've seen from growth, number one, and number two, from a supportive central bank.
Yeah, great points, by the way, and I do think the consumer, thriving is still a big part of it. Obviously, like you talked about, cheap money, if you will, being readily available throughout the world keeps things going.
Yeah, I was just going to say that, to follow up on what you were saying, is that along with the evolution that we've seen in the financial markets with computers, the evolution in demographics in the United States, where the consumer used to be 40 to 50% of the economy. So a healthy consumer, as Adrian is saying, is really critical.
Yeah. I think that's going to do it for our recap. Again, great information, guys, today. I thought it was super helpful. And for all of you, please tune in for more. We'll have plenty of insights. I know, Adrian, you write quite a bit. And if you have any questions, feel free to message your advisor. Thanks.
Thank you.